Howdy and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald. Thank you so very much, as always, for joining me. You know, headlines are trumpeting the fact that the U.S. 30-year Treasury yield has now topped 5%, while the 10-year yield is now top 4.5% on deficit concerns. Nice try. U.S. debt has hit those levels because debt buyers, are walking away as traders reprice risk. Something we've been talking about since last Sunday when I warned you very specifically in my Sunday evening short about this together with a downside test this week. Now, remember how the game is played. Highly leveraged traders, aka the big money, borrows boatloads of moolah to magnify their returns. When rates rise like they are doing now, the vigorish costs more, so they sell to A, reduce the risk of institutional size margin calls by reducing what's called their VAR, value at risk, and B, because every dollar they'd otherwise fork over in interest to pay for their leverage costs more, while also becoming a performance drag, both of which, ironically enough, reduce their bonus potential. So they hit the sell button. So what do? Well, it's funny you should ask. Here's my playbook. Number one, this really is a big deal. What events there mean for your money here? I sat down with my friend for a wide-ranging interview, the fabulous Scott the Cow Guy Shelley yesterday. He wanted to know how and why the spike in Japanese government bonds would impact investors here. Now, it's not something that's widely talked about because, frankly, most financial advisors haven't got a clue how international markets work, let alone how they're linked to U.S. markets and European markets. But they probably should take a page out of the playbook. This really is a much bigger deal than people think for reasons I go into in the video, which is why smart investors will pay attention and heck, I submit already are. Watch that video elsewhere on the channel if you get a chance and keep this in mind. Low beta, high divvy stocks, dividends, high divvies are going to be your best friend if there's some volatility ahead like I think there might be. Now, hopefully you've got your own shopping list, but you know where to find me if you don't and you'd like mine. Number two, just how dirty is United Health? Now reports are surfacing that the company has secretly, apparently paid to reduce hospital transfers. I mean, this just goes from bad to worse. As I noted on April 17th, right here, this company is a disaster, and what's happening is very likely the tip of the iceberg. Shares are down minus 29.18% since then, which means that anybody who paid attention to what I said and who got on board by shorting the stock or buying putskis, a bet that the stock will decline, is probably doing quite well at the moment. Smiling and dancing are definitely encouraged. I mean, not for failure, but because you've made a good decision. Now, anybody who stayed on board with the stock, oh, faceplant. You knew this was coming. Now, here's something else to think about while we're on the topic. Stuff like this, behavior like this, is rarely confined to a single player when what's happening is very likely a wide-ranging industry pattern of behavior. UNH is simply the first one who got caught. Now, UNH, because of what's happening, gets a rare, quote, avoid like the plague, end quote, from me, as do other insurers who are undoubtedly at risk of similar blowback just because they're guilty by association. At the risk of sounding like a broken record, if you're a dividend investor, beware. This is not going to be pretty when all this gets cleaned up. Here's something to think about too, an investing tip really. People who are playing long only, meaning that they only buy stocks or funds or whatever, are quite literally missing half the profit potential in today's markets. Stocks go up and down, which means there's plenty of profit potential in both directions. Now, learning to use options can help, but there are other ways to control risk if you don't want to use the options. Number three, this is a biggie, and frankly, what Uncle Elon said made my jaw drop. Uncle Elon, love him or hate him, had two recent interviews recently, one on CNBC and one on Bloomberg, and you ought to pay attention and watch them. Whether you like them or not is moot. Here are a few of the key takeaways. Number one, Tesla will launch its robotaxi program by the end of June, starting with roughly 10 vehicles in Austin, with expansion planned for LA and San Francisco in relatively short order. Musk also confirmed that Tesla is to open licensing FSD and is already in discussion with other automakers. Now, this is exactly as I told you would be the case, by the way, and it is very similar to when I told you years ago that charging would become the de facto standard globally, and the real-time database that he's accumulating is going to be the most valuable data on the planet. I mean, just wait till insurance companies have at it, which I can all but guarantee you is coming. And finally, as mentioned in yesterday's 5 with Fitz, Musk said he will also focus more on Tesla and his companies going forward, which is, frankly, about time in my humble opinion. I'm an investor too. Now, he also mentioned that both Tesla and xAI will continue purchasing GPUs from NVIDIA and AMD to support their growing AI capabilities. So all these were great. But the biggest development, the one that made my jaw hit the floor, is being treated almost as an afterthought by the mainstream media, which has all but glossed over this. Here's what he said. Optimus, Tesla's humanoid robot, is now getting close to being able to learn tasks by watching video. This is a monster development and a major leap in embodied AI development. Let me explain why. I mean, again, love him or hate him, Musk made it very clear that we ain't seen nothing yet. And I agree with that statement. Robots that learn by watching represent a massive leap forward, not just in AI, but in how machines interact with the real world. Observational learning, which is what the robots are very close to doing, is a deeply human skill. It's how we learn to tie our shoes, cook a meal, or often fix a leaky faucet without needing reams of code or instructions. Now, if Tesla's Optimus can watch and learn, we're talking about next level stuff in embodied AI, machines that gain contextual understanding and begin forming real world logic from experience. Now that, folks, is an entirely different ballgame than the pre-programmed step in code. It could also be the first real steps towards robots reasoning in both quantitative and adaptive terms, meaning recognizing patterns and adjusting on the fly, even innovating. Not just repetition, but cognition. This isn't just a better robot or a mousetrap here. It is potentially a new worker class, a new economic layer, and of course a new AI frontier that investors would be incredibly foolish to ignore, in my humble opinion. Now, again, I get that most folks, or many folks, can't get by Musk himself, and I respect that 100%. There's nothing wrong with that opinion. But I don't have the luxury of taking sides in my capacity as an investment strategist, which is why I would be remiss if I didn't say what I'm going to say next. I hope you're on board, if not with Tesla, with something else in the robotic space, and you think seriously about getting on board, because a few years from now, I think it is very likely, probable actually, that anybody who isn't is going to rue the day that they could have bought Tesla for just $344 a share. Now, my POV, I hear from investors time and again about how much they regret not taking action when they had the chance in a situation like this. I mean, imagine, for example, putting just $1,000 into NVIDIA in early 2011 when it began to shift almost imperceptibly into AI. That same $1,000 would be worth $336,300 today. The same $1,000 put in the SPY, which would be a great choice, is worth $4,633.63. Now, you can do the math just as easily as I can. That is a life-changing difference for anybody who acted, but also for those who could have but didn't. By the way, the OBA family, in case you're wondering, and you're part of that, is already working on and ahead of several similar life-altering developments in a variety of industries and building a list I call the must-have portfolio. Now, hopefully, that's neither here nor there, hopefully you're making similar moves with your own money and you've got a similar list. Let's talk about number 4, Google. Don't forget about us. I can only shake my head here. At its I.O. event, Google dropped AI Ultra, a $249.99 a month subscription that gives you access to its most advanced Gemini model, some experimental toys, 30 terabytes of storage you'll probably never use, and you guessed it, YouTube Premium. I mean, wow, that's a deal breaker. Oh boy. I mean, seriously. The company also showed off Veo 3, their new AI video generator with audio, and rolled out a $150 million partnership with Warby Parker to build smart glasses with real-time translation. Now, that, of course, sent Warby shares up 15% because apparently, nothing gets investors excited like deja vu and eyewear. But let's call this for what it is. More Me Too tech dressed up as moonshots. Another model, another demo, another pair of glasses that finally might not make you look like a cyborg. Maybe. Everybody's racing to be second to everything, and Google's leading the pack from behind. Unless smart glasses magically become a must-have platform, this doesn't move the needle. People said virtually the same thing about GoPro back in the day, by the way. As for Google delivering the kind of breakthrough, I'm not holding my breath, and I encourage you not to either. I've avoided Google for years because nothing I see here changes that. They used to lead, now they just follow, and not all that well, in my opinion. And finally, number 5 today, cybersecurity isn't sexy until you need it. And by then, it's too late. Just ask Marks and Spencer. It's a British retailer, and they said that a highly targeted cyber attack will reduce its fiscal 25-26 operating profit by £300 million, or approximately 30.5% of annual earnings. I mean, think about that. The company reported that the breach, which apparently occurred over the Easter holiday, disrupted online sales, left physical store shelves bare. In response, CEO Stuart Machin announced that Marks & Spencer will accelerate its existing technology overhaul. You think? Condensing a 2-year transformation plan into just 6 months. Okay, about time. Marks & Spencer also said that the estimated loss would be offset in part by insurance, cost management, and other trading actions. So bottom line is, the dog ate their homework and now they're going to try to make something else pay for it. But the way I see it, the financial damage is ongoing, and the disruption has already erased more than £1 billion in market value, with online operations expected, get this, to remain impacted into July. Now, Matson declined to confirm whether a ransom had been paid, but attributed the incident to human error. He emphasized that the company is now moving forward, calling the event a window of disruption that will fast-track long-term tech initiatives. Translation, cyber got ignored, the bill came due, and now the C-suite suits are trying to spin it as a good thing. Now, my investing tip in this arena is really, really blunt. Any investor who isn't taking cybersecurity seriously in today's day and age isn't paying attention to the world we live in. A single click can cost a company like Marks & Spencer billions of dollars, which is why I believe that every investor portfolio should include exposure to cybersecurity, not just as a hedge, but as a cornerstone. I mean, it's not like this is a surprise. Digitalization, which is the largest of the 5 Ds we follow in the one bar ahead world, is the largest investing theme potentially in recorded human history. And every business on the planet will adapt, adopt, or die. Now, my favorite choice in this space is returned 63.9%, while Bug, a popular cybersecurity ETF, has tacked on 12.47%, since I mentioned you have a look at it on August 27, 2024, in the 5 with Fitz right here. The SPX, by comparison, has returned 5.59% over the same time frame. So you can do the math just like I can. Today's bottom line is very simple and especially appropriate for a down day. People think you make your money in bull markets. But let me tell you something. The real profits get made when the bears come out to play. So be the hunter, not the hunted. As always, let's make it a great day. You got this, I promise. Thanks as always for watching, and I'll see you tomorrow.